In the last session, you would have seen basically what we were looking at. We were looking at the calculation from the capital provider point of view. From the capital provider point of view, I talked about what is called as the PE multiple is what I was talking about in the last lesson. This PE multiple, when I say, it is the number of times that you multiply with what do you call it as the earnings per share to derive what is called as the value or intrinsic value of the shareholder. Now, many times what happens, this can be used as a proxy. For example, company A and company B are almost similar, and company B, I am not very sure about the value because the market is not treating it very fairly. I can know the PE of the company A and use the same PE almost with a little bit of what do you call it as adjustments of plus and minus, and multiply with the EPS of the company B to know what is the intrinsic value of the company B's shareholder. So, this PE multiple can be used in multiple ways. So, what did we look at? We looked at what is called as the from the capital provider point of view in the last class. From the capital provider, that is, first we started with what is called as the debt provider. What is he interested in? I am interested in what is called as the debt and equity part of it out there, and debt equity ratio, that is what we said. Then I moved to what is called as the interest coverage and what is called as the timely repayment of principal, and that is what we talked about, that is interest, and this is what we call it as the interest coverage ratio out here, and this is what we call it as DSCR, debt service coverage ratio out there. This is what I will call it as debt service coverage ratio. This is what I call it as debt service coverage ratio. Then we moved to from the equity provider point of view. We looked at the risk aspect out there of the equity, as the debt component is higher in the capital structure, the risk of the equity holder keeps on increasing out there. So, we again looked at the debt and equity part of it from the equity provider point of view. And then I moved to what is called as looking at the EPS, the earnings per share out there, and then we looked at the market price out there. Market price is known, and then I looked at calculating the PE multiple out there. These are the basic aspects that we looked at out there. Now, as a capital provider, are you interested only in this? Well, these are some of the aspects. Next, I am interested in what do we look at as, we will say, I am interested in the profitability of the business. Not only are the equity shareholder, debt providers interested in the profitability of the business, there are many other stakeholders who are interested in the profitability of the business. For example, you are an employee of the company. If you are an employee of the company, you will still be interested in the profitability of the business because you want to know whether the business is going to survive, not survive. Only if the business is profitable, it will survive. If it is going to survive, then I will have my job, they will give me my bonus, whatever, etc., etc., etc. So, every stakeholder is interested in what is called as the profitability. Now, what are the couple of things which we look at in the profitability point of view? The first and foremost we look at is what we call it as, the equity holders are interested in what is called as return on equity. What is the return that the equity holders are getting out there? This is nothing but what is the money belonging to the equity holder? PAT is the money that is belonging to the equity holder. PAT is the money that belongs basically to the equity holders out there in this particular case, return on equity out there. Now, when I say PAT is what we will look at as the money that belongs to equity holders, what is your denominator? Denominator is obviously the equity capital. So, what we say is average equity capital in that year. What do you mean by average? For example, on what do you earn profit? On the capital you earn profit, not on the year end capital. Because year end capital is with addition of the current year's retained earnings. For example, let me take for example, I will say for example, let us say 2020 on 1st of April my capital equity, when I say equity capital was 5 lakhs out there. My retained earnings or reserves and surplus was another 1 lakh out there. What is my total equity capital? My total equity capital, my total equity capital, or what do you call it as the total tangible net worth out there, is equity capital is about 6 lakhs. Now, in the year 2020 to 21, 2020 to 21, you have a PAT, a profit after tax of 2 lakhs. What is the capital on 31st of March 2021 out there? That is, my equity capital is 5 lakhs. My retained earnings is 1 plus 2, that is 3 lakhs out there. Assume that you have not given dividend. So, your net worth or total capital is 8 lakhs. So, this 2 lakhs of profit you have earned not on the 8 lakhs, because this 8 lakhs is at the resultant figure at the end of the year. This 2 lakhs capital I have earned on the 6 lakhs, initially the invested capital out here. Is it only initially invested capital? Well, slightly difficult, because on 1st of April you had 6 lakhs. Every day you are making a profit, you are making a loss out there. So, every day, as you saw in the list of transactions I made, my overall net worth was increasing or decreasing with every transaction out there. So, my capital base is changing every day. So, what do? We say average capital for, I will say for the year. I will say my average capital for the average equity capital for the year. So, how do we know? Every day we will have to look at all the transactions. Simple thing, what we do? Opening, that is on 1st of April 2020, what is the capital? On 31st of March 2021, what is the capital? I take average of these two. So, in this particular case, I will take my PAT will basically be divided by the average, that is average of opening plus my average of opening plus closing balance. So, what happens in this particular case? I will say for this particular year, my PAT is 2 lakhs. What is my average capital? 6 plus 8, 7 lakhs. This is what is my average. My PAT is 2 lakhs out there. This is what is here, and the average of these two will basically come here as 7 lakhs out there. So, I will say my return on equity. The equity shareholders are also interested in return on equity. Equity shareholders are also interested in return on equity in addition to the other aspects mentioned earlier. Now, going further on the profitability part of it out here, I would move a little more, couple of more notches out there. We look at what is called as the, I would say, the return on assets. Imagine I have an asset base, my total asset in my company is about say 10 lakhs. My basically if I sort of look at what do you call it as my net income in that particular case out here, in this case out here, what do you say, my net income, or I would say my profit before interest and tax is about 3 lakhs out there. So, I would look at what is the effect of this. So, what do? I will say my profit before interest and tax into 1 minus the tax rate divided by my total assets. Sir, what is this confusing? I did not know, why do you do 1 minus tax rate and everything? We will come to that. I will talk about the next ratio, I will explain why do we do that. Now, park this for the time being, we will revisit it, return on assets. Before that, I will say return on they will say capital employed or return on investment or return on invested capital, etc., etc. All these things mean the same. Now, let us define what that is. They will say return on the capital. Now, let us define the denominator. What is the denominator? Denominator is the capital. What is the capital? Equity share capital, average equity share capital. Yes, agreed. Plus, what is the other capital? Debt capital. Sir, no average for this? Yes, average for this. When we say debt capital, we mean only long term borrowing, no short term. This is what is capital. Denominator is capital, that is, this is the capital that is employed, this is the investment that is made, this is the invested capital. Now, what is the numerator? Numerator is the return. What is the return? Equity share capital holders do what do get, I mean they get, what is the kind of return what they get? What is the kind of return? The return these people get is profit after tax. Agreed? Return these people get is profit after tax. What is the return the debt capital holders get? The debt capital holders get the return that is called as interest. And what did we see here in this particular case? What we did out here in the last example out here, debt interest what you pay is always before the taxes out there, before the taxes. So, what do we do? So, I want to nullify what is the advantage that I am having because of the taxes out there. So, I do 1 minus. Still not clear, I know that. Still not clear. Now, let us look at, I am going to take an example out here. Please watch out, I am going to take an example. I have two companies, A and B. A has an equity capital of $100, B has equity capital of about $60. Now, A has a debt capital of 0, B has a debt capital of 40, the debt interest rate is 10%, again for ease of multiplication. So, both have a capital, total capital of $100 out there, total capital. Now, couple of statements. Both A and B, same industry, same product, same market, same price and same market share. This is the assumption I am making out here. Now, they make the profit before interest and tax, both make a profit before interest and tax of $10. Now I will say my interest component is 0 here, $4 here, because on 40, 10%. Now what happens? My what is called as profit before tax is so much. My tax, again I love 50% of taxes. So 50% just because of what do you call it as ease of multiplication, $5 gone, $3 gone. My profit after tax is about so much. Now what is the invested capital in both? The invested capital, now let us say ROI, return on investment or return on capital employed, whatever name you want to call it. Denominator, let us say, let me do one thing. Let me do it out here. Now I will say my return on investment or return on capital employed or return on invested capital, whatever you want to call it by. Now for A, what is the denominator? Denominator is only equity $100. What is the numerator? PAT $5. That is PAT by whatever, PAT by invested capital. Whereas for B, when I look at what is the invested capital? $60 equity, $40 debt out there. Same 100. What is the return? Equity holders get $3, debt holders get $4. Now what is the return? This is 5%, am I right? And this is 4 plus 3, 7% out there. So do you mean to say company B is better than company A? Well, yes and no. Why yes and no? Company B is better than company A, that is what you feel, not because of their performance. Of their performance, both have got the same $10. A is better than B, B is better than A, that is what you feel because of the advantage of their capital structure. Because of their capital structure, that is, they have divided the capital, not because of their performance, not because of their ability to manufacture the product, better product, or ability to sell better, or ability to earn a better margin. No, they are earning the same margin here. They are not earning from their core operations. Why is it better? Why does it look better? Because they have what is called as this $4 is pre-tax. So if I have to compare, I have to compare like to like out there. I cannot say and invest in this company saying that it is better. It is just better because of their capital structure, not because of their performance. Performance both have the same value because both are earning the same $10 out there. Both are earning the same $10 out there. So when both are earning the same $10 out there, as you see the PBIT, their performance, core performance is exactly the same. The core performance is not different at all. They are one, you feel one is better because of the capital structure. So when I have to compare these two, comparing it like this is illogical. Comparing like this is illogical out there because I am not comparing their core operation. I want to compare and core operation and take a decision. So what do? I will say I will calculate it as $5 PAT by 100 agreed. In this case, $3 agreed plus $4. On these $4 I have not paid tax into 1 minus T. 1 minus tax rate is 50% out there. T is 50%, tax rate is 50%. Divided by 60 plus 40. But I want to take out the tax advantage what you are getting because in any way if I had not used debt as a capital, I had used equity as a capital, I would have to pay tax. Tax is inevitable. So, that advantage what you are getting because of the capital structure, I want to knock off. If you do that, then both will have the same 5% out there. This extra $2 out here you are getting not because of what is called as performance, purely because of a capital structure choice. Is capital structure choice not part of that? Yes, it is. But imagine you are looking at buying one of these two companies. Then the other company, B company, will say, I am earning 7%, so pay me more. But once you buy, the capital structure can change. Capital structure can change every day. Why? Because as you saw in the balance sheet and the P&L when we did the transaction, your profit is getting added every day. So, your debt and equity ratio keeps changing every day. So, your capital structure can keep changing every day, right. So, when your profit is getting added at every transaction or loss is getting added at every transaction, what happens to your capital structure? That changes every day. So, capital structure, the advantage you are getting because of the capital structure, I want to nullify that effect, and that is what I have done. So, what is it? I am comparing with for their core operations only, and that is what I have done. So, what do I do? In this particular case also, if I have to look at calculating this, I will use this, what do you call it, as 1 minus tax rate on the interest, because interest is pre-tax. So, the same is the case when I did the assert. The PBIT, the profit before interest and tax itself I took, I can actually do this. Instead of doing what is called as PAT plus interest, I can just take PBIT, profit before interest and tax, because all that this profit before interest and tax includes the interest. On this, I will just knock off the taxes part of it, then I will say my average capital debt plus equity, average debt plus equity. That is all what I am looking at. So, that will give me my, what do you call it, as this, and the same is in this particular case also. I hope I am clear. Any questions, you can always write to me, I will always respond, or during the tutorials my TAs will always respond. Now, moving further on the profitability part of it, there are a couple of other things. We look at net profit margin or gross profit margin, I will say net profit margin or gross profit margin, or what do you call it as, basically these are some of these things what you do. What is net profit margin? I will say my profit after tax divided by my what is called as total income, my total income out there. Whereas when my gross profit margin, what do? I will say my what is called as my gross profit divided by my operating income. Now, what is the difference between these two? If you look at an annual report, if you look at a P&L statement, for example, every organization will have revenue from core activity and revenue from non-core activity. Now, when I say total income, my includes both revenue from core and non-core. When I say operating income, I am talking only about the core activity, okay? Because the profit after tax will include all the profit that you have derived from the non-core activity also. For example, pick up a balance sheet, any company's balance sheet. You will have income from sales, perfectly all right. Or let us look at an automobile company, automobile out there. Income from sales, yes. Service income, yes. I've invested money, my excess capital in excess money cash out I have in various other liquid mutual funds and everything. I'm earning interest on that. Now, is that a core income? No, that is not an income from core activity, revenue from core activity. What is my core activity? Manufacture vehicle, sell the vehicle, sell service the vehicle. That is all. That is core activity. I have extra space. I have rented it out to somebody. When I have rented that space to somebody and I am earning a rent on that, is that revenue income on the core activity? No, non-core activity. What is my core? My core is only manufacture vehicle, sell vehicle and then as a what is called service the vehicle out. So, when I say PAT, my profit after tax will include all basically the what is called as a profit that is generated from the core and non-core. So, here total income means total what is called as core and non-core. Whereas, when I say gross profit, I am looking at only the manufacturing cost, I am not looking at the additional costs out there. What is the gross profit what I have? Gross profit is, I would say, my core sales minus my manufacturing cost. That is all. This will result in what is called as gross profit. And my operating income is nothing but the core sales. I want to know whether you are making profit in the core activity. There are companies which will say overall profit by PAT by total income, net profit margin will always be positive. But gross profit margin level they will be negative. There are companies, there are instances. That means you are never making money from your core activity, you are making money from the non-core activity. So, then is it worthwhile for you to continue your core activity or just siphon off the core activity and continue the non-core activity? You do not know. One might argue the core is driving the non-core, all kinds of confusions will be there. Let us not even get into that area at all. So, I will look at these aspects also. With you on this?